I'm joined by my colleague Karen Manczko, who will provide an update on the Wespath Fund's performance. Karen, thank you for being here.
Thanks, Joe, and greetings everyone from Glenview, Illinois.
I mentioned earlier that the economy continues to show resilience, but with some weak points showing, specifically with the spike in the long end of the yield curve. The stock and bond markets saw negative returns on the quarter. With this said, Wespath funds were not immune, correct?
That's right. Our equity funds had a strong first half of 2023, but followed their benchmarks lower for the third quarter. U.S. equities were lower by 3.3% for the quarter, but fortunately, they're still up 13% for the year. International equities were down 4% and are now up 7% for the year.
So looking closer at bonds, while the data has been stronger, we've seen what may be considered cracks and bonds sold off at the end of the quarter.
That's right, Joe. We're currently absorbing the notion of rates remaining higher for longer, indicating that once the Federal Reserve concludes its tightening cycle, which is anticipated happening this year with a final 25 basis point hike, it intends to maintain interest rates at these elevated levels for an extended period of time, possibly well into 2024.
And the Fed signaled that they're nearly done at the September 20th meeting, and yet rates moved higher after that?
Yeah, one of your favorite market pundits, Jim Bianco, suggested that the bond market reacted negatively to the idea of just one more rate hike, perhaps because bond vigilantes did not believe inflation is contained. Bonds sold off at the end of the quarter and are now in negative territory for the year.
Great, thanks, Karen. Now let's talk about the Wespath funds. Starting with equities, can you give us a rundown for the quarter?
Yeah, you can see that the Wespath equity funds ended down for the quarter with both our U.S. and international equity fund composites down over 3% and 5% net of all fees. I'll review the specific contributors and detractors to our quarterly fund performance here in a moment. Although the quarter showed negative returns, the year-to-date performance of our equity funds has remained positive. The U.S. equity funds are now up 10% and 12% respectively, while our international equity fund has also managed to stay positive, returning 2% net of all fees.
So negative absolute performance in terms of equities for the quarter. And from your previous comments, fixed income was also down for that time period.
Yes, both were down on the quarter, with much of the bond losses coming in September. The fixed income fund composite fell 2% for the quarter. Year to date, despite the bond market being negative, the fixed income fund composite was positive and returned over 1%.
That's great that the fund returned a positive year while the rest of the bond market was negative for the same period. What do you attribute to the strong relative performance to this trailing time period?
The fixed income fund composite demonstrated remarkable resilience in the face of a challenging condition in the bond market. The composite is primarily actively managed, therefore the collective work of our active managers and their issue selection, along with navigating the yield curve and duration in this challenging environment, has benefited our investors. Also, the composite's overweight to high-yield bonds has been a strong contributor to the long-term performance.
All right, before we move on, any comments on the other bond fund, the Inflation Protection Fund?
Yes, a few updates. Similar to the fixed income fund composite, the Inflation Protection Fund was down 1.5% for the quarter and was positive year to date, despite the benchmark being down.
Thank you, Karen. So before you talk about specific contributors and detractors, let's get a sense of where we are compared to others in the industry. Can you tell us how the multiple asset fund composite compared relative to other balanced funds?
Yes, of course. This chart showcases the multiple asset fund composite versus a universe of balanced funds. This slide measures how our balanced fund performed relative to other balanced portfolios and funds that are currently on the market. Looking at the chart, you can see that the multiple asset fund composite has performed above the median across all time periods, with the exception of the 3-year, which was slightly below, as you can see from the chart. But the 10-year time horizon, the multiple asset fund outperformed 57% of its peers.
Great, thanks, Karen. Now let's get to the contributors and detractors for the fund's quarterly performance. Can you break down what helped and what hurt the funds in the third quarter?
On a gross of fees basis, the multiple asset fund underperformed by 66 basis points in the third quarter. No surprise that the positive contributors to the fund's relative performance was the outperformance by our two fixed income funds, which comprised 35% of the multiple asset fund. The primary detractor to the performance was the equity funds, which I'll talk about here in a moment.
Thank you. And fixed income funds experienced negative absolute performance. They outperformed on a relative basis. On the other hand, our equity funds faced a decline for the quarter and underperformed their benchmarks. So let's dig into that a little bit more.
Starting with the U.S. equity fund, this fund underperformed its benchmark by 17 basis points for the quarter. Strong stock selection by our active managers in energy and technology contributed positively to the performance. One strong position from an active manager was WII, which is a software company that offers a platform for insurance providers. This stock was up 18% for the quarter due to a strong increase in sales. Also, energy companies that our asset managers invested in were a benefit. One example is Apache Corporation, which was up 21% for the quarter.
And what were some of the detractors for the U.S. equity fund?
The main detractor was the fund's overweight to small and mid-cap growth stocks and corresponding underweight to mega caps, specifically mega tech or the Magnificent Seven that has been highlighted so much these last few quarters. These companies are Tesla, NVIDIA, Facebook, Google, Microsoft, Amazon, and Apple.
And why have these mega cap names continued to do so well?
Well, for one, these mega tech names have actually been benefiting from rising interest rates. They are earning more in interest income than what they are paying in interest expenses. As I highlighted last quarter, we are invested in these names, but the weighting our fund has to these stocks is less than the benchmark. This is primarily where the mega cap stock underweight makes an impact. Some of these 7 stocks have returned almost 200% from NVIDIA and 150% from Meta, which is Facebook's parent company. These Magnificent Seven has contributed to 92% of the return in the S&P 500 so far this year.
You mentioned that the International Equity Fund underperformed its benchmark for the quarter. What were the drivers of the fund's relative performance?
The International Equity Fund underperformed by 240 basis points. The primary reason for the underperformance was stock selection by the fund's active managers, particularly in financials, information technology, and industrials. An example is a financial company called Adyen, which is an online financial tech company. This stock was down 57% during the quarter.
It sounds like active management played a big part in the fund's underperformance. Any other contributors you'd like to highlight before we move on?
Yes, the fund's allocation to private equity contributed positively to the performance.
Interesting, and thanks for highlighting that. Now let's talk about bonds and how the 2 fixed income funds performed on the quarter.
As I mentioned earlier, despite the bond market being down during the quarter, the fixed income fund outperformed by 52 basis points. We do not report on the fund's duration in the webinar, but the fixed income fund has a shorter duration than the benchmark, which helped us, and it's important to note that duration measures how sensitive our fund is to the rise in interest rates, which rising interest rates is negative for bond prices. So with this said, there was a meaningful rise in rates that happened during the quarter, and the fixed income fund was not as sensitive to that rise in rates due to our shorter duration. So the impact was not as meaningful to the fund's relative performance. Relative to the fund's benchmark, the fund is overweight high-yield bonds, which contributed positively as those bonds did well during the quarter. Also, high-yield bond manager issue selection contributed positively as the manager invests in higher quality, higher yielding bonds, which helped. Also, the emerging market debt manager's issue selection, particularly in Latin America, contributed to the fund's performance. The final positive contributor was the fund's allocation to our internally managed positive social purpose lending program.
It looks like there's no detractors to report for the fund, so let's move on to the final fund, the Inflation Protection Fund.
The Inflation Protection Fund outperformed by 29 basis points for the quarter. The fund's allocation to floating rate senior loans helped as we saw rates rise during the quarter, and these loans are higher yielding, which also performed well. Also, the commodity manager's issue selection helped as they were overweight energy. A detractor to the fund performance was its allocation to emerging and international developed market linked bonds. Emerging market and international developed market linkers underperformed U.S. Treasury inflation protection bonds in the third quarter. Also, these allocations are out of benchmark allocations. Therefore, the poor performance was a detractor to the relative performance.
Thank you for that performance summary, Karen. We appreciate you being here.
Thanks, Joe.